Greetings, my name is Kevin Matthews and I am the tax professor. Remember, class is still in session because the learning never stops. This is a very interesting subject. I took this because I thought it was funny. Actually, when I was pulling a lot of this stuff down was when some of the lottery numbers were hitting to the higher numbers. And I'll be honest, every now and then I drop a couple bucks just in case. It's usually something that I'm like, okay, well, I want to have Starbucks today or whatever. It's definitely, and first of all, just allow me to put this out there. I have had friends who've had gambling problems before. If you're having a gambling problem, seek help. There are definitely a lot of resources to help you out with that. But if you're not, and you're just having a lot of fun, and you're just kind of like, hey, I want to go ahead and shoot for the winnings. So guess what ends up happening? You get this amount, so you put it in, you get this amount of money back, and or you get your ticket back and you find out you hit the big one, and you now have $100 million coming to you. What is going to happen? First of all, obviously, it's going to be taxed, okay? And then you're going to learn a lot of the same problems that people who are extremely wealthy are learning. So first of all, they are taxable. In the case of winnings and for fair market value of any non-cash prizes you win are also taxable. I know a lot of people, and I know we're talking about lottery winnings, but this also applies if you go on a game show. I remember watching these, when I was a kid, used to stay home from school. Usually I just plop myself in front of the television, wrapped up because I'm trying to, get better. As my mom's feeding me chicken soup. Gotta love mom. But you see these people and they do the Price is Right, and they do the showcase showdowns, and they win all these prizes. What happens? And they have the same problems that the lottery winners do, in that, hey, if you're going to win a car plus trips to various other places, plus cash, plus other types of prizes, they're going to take the fair market value of those gifts and prizes, and they're going to charge you taxes on those. Okay. Now, I have known that generally most game shows will not pay those taxes for you, but they will give you an option to, have them, to get services in order to be able to figure out what those taxes might be. I think for the most part, lately, they don't do a whole lot of help. They just kind of say, hey, look, we need you to fill out this W-9 because we need your social security number. We're going to report all this stuff to you and pay the taxes. Good luck. Okay. I did know one person who actually won on a game show once. They had to actually sell the prize that they won because they couldn't afford the taxes on it. And that's really heartbreaking because, you go on this game show, you're having a lot of fun. You made them tons of money, and now you're getting this huge hurt. My personal opinion, the game show guys should probably just gross it up because they just want to seem like the good guys. It's not like they're losing millions of dollars. They're making millions of dollars off you. But again, it's a business. I get it. I understand. So you win the $100 million. Guess what, folks? You're going to be taxed at that highest tax rate, which is going to be 37%. Okay. You also will likely be subject to the state income tax. Okay. Now, I've been told, and I'm pretty positive that this is the case. If you buy the lottery ticket in your home state and you win, obviously you're going to pay the home state tax, not anything that's unacceptable. If you buy it in another state, that state can still theoretically charge you the tax on that. Okay, so very good example. I live in the Washington, D.C. DMV area. DMV stands for the District of Columbia, Maryland, and Virginia. Okay, I could be downtown D.C., as I go downtown D.C. a lot. I'm very involved in some social groups down there. And on my way home, I reach out and, I'm filling up a gas tank and I'm like, oh, wow, it's up to, $200 million. Yeah, I'll buy, I'll stick $5 into it. And I win. D.C. gets to tax me on that, even though I live in the state of Virginia, unless there's a treaty between the states that says we will not tax you. I can't imagine D.C. and Virginia have a treaty like that because it would cost D.C. so much money. But what will end up happening is you're going to have to file, and you will be able to file, and you can take a state tax credit on some of those taxes that you pay to the other states. So, again, if you have that problem, you want to reach out to a CPA, especially one who's dealt with high net worth earners like I have, or other CPAs who have dealt with high net worth earners, and they'll be able to help you out with a lot of that. So on the other hand, they also like, in addition to talking about gambling winnings, we also like to talk about gambling losses. Now, one of the things you have to understand is, yes, every time that I bought a lottery ticket, it potentially was available for a gambling loss. Okay, now in order to get said gambling loss, there's certain amounts of deduction, or certain amounts of documentation that you have to do. Okay, so it is an itemized deduction. However, it is not one that is subject to 2%. Therefore, under the most recent tax change, they didn't get rid of this when they did the tax changes. Okay, so that's actually a good thing. I was actually, it's not just this one. I have a couple others that I deal with that are not subject to 2%, and I was worried those were going to go away. So I know this one didn't go away for that reason. So essentially, if you have those gambling losses, you can take it against the income you have. Now, if you win $100 million, I can't imagine you're going to have a significant amount of gambling losses that's going to offset it. But if, maybe you win only $100,000, and you say you spent, $10,000 on lotteries and casino winnings and all that and casinos and all that stuff. You can pull all that together, and that, as long as it happens within that calendar year, you're good to go. Okay. Now, what you have to have, you can't walk up and just say, well, here's my lottery ticket proving that I bought it. It doesn't work anymore. And some people might ask, why is it that doesn't work anymore? Why wouldn't that work? If I have the lottery ticket, obviously I bought it. We don't know that. Okay, the IRS doesn't know that. And if there was the good old days, what would happen is that there would be people, back in the good old days of the horse races. They still happen, but they're not as prevalent as they used to be. But the good old days of the horse races, there'd be people who do the gambling. These are the guys who are going to the horse races on a daily basis, if not a weekly basis, and they're just picking up old tickets. And the reason why they're picking up old tickets, they hit the big one. I'm going to offset it against all this stuff that I bought. IRS has no idea whether you bought it or not, and that's to prevent that from happening. And so you have to have a receipt. And most people, I guarantee you, I bought lots of lottery tickets. I've never asked for a receipt on it. So that's something that you want to make sure that you do if you're planning on using gambling losses against gambling winnings. The timing as to when these are taxed is when they're constructively received. Now, what does it mean by constructive received? Constructive receipt. Now, constructive receipt basically says, hey, look, I have all legal entitlements to the money. The money is on the way. It is likely to be paid. But what ends up happening is I only get taxed on it when cash is received. So, very good example, and I talk to people about this all the time. Kevin, if I'm going to receive a lump sum versus receiving the installment payments, which one ends up being better for me tax-wise? And my personal opinion is that if you win, $300 million, I've always been one of those people that says, rip the Band-Aid off, take it all in 1 year, and then, hire a really good person to do all your investing for you, and you'll be fine, in my opinion. But I've always been of the mindset that I don't think taxes is as much of a consideration as to whether you should be doing the lump sum or the installment. Now, everyone's got an opinion on this. I have very good friends of mine that say, well, but Kevin, up until the, whatever the max tax rate is, the income brackets, you're not paying the full tax. So over time, it actually works out being smaller to get that. But then you have the cost of time value of money. But if I got all that money up front, took the Band-Aid hit as it was, and then later on just went ahead and socked the money into the stock market, and I made, 8 or 9% off of it every year, I would have more than make enough to make up for those tax hits that I got. So again, I get this question a lot. I always say it depends on what your goals are. If you're going to take this money and you want to live for the rest of your life, probably better to do an installment plan. If you want to take this money and you have major plans with it, like you want to go set up your own little Donald Trump empire, or you want to go do, McDonald's stores all over the place, then that's a different story. And that's why you might want to consider taking the lump sum, because you have a better plan for it. Now, I do know for a fact that there are financial planners that specialize in working with lottery winners. If you win the lottery, you want to find these people to work with you. I have several of my clients who are gamblers. They gamble a lot. They ask me about gambling stuff all the time, so we all talk about it. I like to fancy myself as a poker player. Obviously, I'm not on the tour, so obviously you know how good I am. But I mean, I've always thought of myself on Hold'em. I've been pretty good, but there's always new skills that I could learn. But every time I go to the casino, I usually make money. So I mean, it's not something that I'm unaware of, and how things like that work out. Now, do I dedicate myself solely to lottery winners? No. First of all, that'd be a dying business, just because of the fact that, the lottery winners, people usually, one thing you're going to realize when you've won lottery money, people are going to come out, you're going to have family members you never even knew existed. They're going to be coming to you asking for money. All right. So the last thing you need is a CPA who's, kind of sticking his finger up his glasses like this and saying, you need to hire me because I can take care of you. Okay. You probably want to find somebody that you're comfortable with. Okay. And that to me is far more important than anything else. You need somebody who's going to treat you like, like the big client you're going to be. All right. And so you don't want to go to some small-time guy, but I don't necessarily think that you want to necessarily go to one of the big four and hire one of them unless you've won an obscene amount of money, because those guys are going to bleed you dry on stuff. I would definitely say talk to a regional firm. Or talk to somebody who's dealt with high net worth earners in the past, like myself. Even though I'm a small-time person, I've dealt with enough high net worth earners, and I'm talking, I've dealt with people into the billions. You definitely want to deal with people who are, able to help you out in this major change in your life that's about to take place. The last thing I want to talk about is shared ownership of the lottery ticket. You may so what ends up happening is you want to be careful about how you've done that shared arrangement. All right. What happens is that you have to establish that the ticket was owned by multiple persons, you and the persons whom are sharing the prize, before the ticket was declared to be a winner. All right. Generally, if you do these office pools, you want to get a signed document from everybody that's participating in the pool that basically says, look, we're going to participate in the pool, winnings are shared, and look, I always, and this is kind of like a partnership, and I always tell people, look, partnerships are like marriage. Everybody gets into them easy, and they are very hard to get out of, all right? And trust me, once you get about $100 million on the line, everybody starts clamoring for themselves, all right? There's some people who are going to basically be like, I'm one of 20, won $100 million. I'm happy taking my $5 million and go sitting on a beach. I'm happy. There are some people, they get greedy, and they're going to try and take every red cent that they can get out of you. And sometimes, and I hate to say it, they're going to hire some of these shark lawyers that are going to be willing to take every money that they can get out of you. So you want to make sure that you set up that agreement, and it's usually the responsible person who does it. And so if you're the responsible person, make sure that that gets set up. Oh, I'm sorry. And there is one other thing I didn't want to talk about. I've had some people who tell me, well, if I won the lottery, and say it's $100 million, I'm going to give away 50% of it, because I don't need that much money to live off of. First of all, good for you. I mean, to be honest, who needs $100 million? Okay. And then I have many of my friends who say, well, then I'll get a nice tax break off of it. Well, up until last year, up until 2018, I would have said, no, you won't. And the reason is that there was this thing called the P's limitation that was going to prevent you from getting any itemized deductions on your tax returns, simply because of the fact you made too much money. Okay, so what we would end up doing is that what's going to happen is you're going to have your income, and then basically you're going to do what's called a charitable contribution that's going to give you a deduction. Okay, now you're only allowed to claim up to 50% of your income as that charitable deduction when you get it. So now if you're giving away half the money that you just won, you're going to more than qualify for it, but it's going to be a little different. And so there's a possibility that there could be some problems with it. There's some people that I've dealt with that, they come into a lot of money. The first thing they want to do is find out a way to do donations on it. There's smarter ways to do this, okay, than just walking into your local YMCA and saying, here's half my lottery winnings. Okay, and look, we're not doing it because we want to control who it goes to. We just want to control how you get it to them so that it's in your best interest and theirs. Because if you give it to like some animal homeless shelter down here that only staffs 10 people, and you give them, $2 million, they're not going to know what to do with themselves. Okay, so you want to make sure that you are giving it to them in such a manner that they can survive and do the mission that they need to do, but not overextend themselves because all of a sudden they think they've hit the gravy train. Okay, and there's definitely some ways to do that. There's also some additional considerations you want to take into account. Number one is the divorce. I will tell you that I've heard, and again, this is based on statistical stuff that I've done with my readings, divorce rate amongst lottery winners is huge. And one of the reasons why is because once they win the lottery, and usually it's one spouse who won and the other one who didn't. One sometimes gets a little, greedy. Some people decide that they, get to live the high life, and they start, doing things that they wouldn't do normally. I will also tell you something, that money changes people. Okay, and I don't care if you are, two absolutely outstanding, good moral characters. Once you get that kind of money, there's a lot of inhibitions that you originally had that are no longer there. And so there's some people who start doing stuff that just, it really destroys a relationship. And so as a result of which, you need to make sure that it's set up where it's going to go who it goes to. Now, this will change depending on the state you're in. Okay, and reason why I bring that up. A good example, you live in a community property state, which is states like California, Texas, I believe, Arizona's one, I think New Mexico's one, California's one, I just said California's one, Washington State is one. Two people who are married automatically own 50% of everything the other person owns unless there's a prenuptial agreement on. And that's why in California, prenups are like very, very common. All right. In other states, you might be under common law. In common law, the money belongs to whoever received it. Okay, and so you want to make sure that things are set up correctly so that if there ever is a divorce situation with this, that number one, you can make sure that if it's due to somebody being misbehaving, that maybe their right to that money kind of gets limited. So there's a lot of things that need to be taken into consideration with a lot of that. You also want to be careful about estate taxes. Okay. There's plenty of examples where people who were multi-millionaires many times over, basically what ended up happening is they said, we're just going to keep the money and we're going to invest it, blah, 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 so on and so forth, we're not going to do anything special with it. And then they pass it on to their children, who, number one, they probably misspend it. Another problem that they can run into is the tax situation. If they inherit $1 million, and I won't say $100 million. Yeah, say it's about $100 million. There's an enormous tax burden that's going to be passed on to your descendants. And so there's ways that you can take that kind of sort of money and pass it on to them through the use of other vehicles. And those vehicles definitely exist, and CPAs and tax attorneys especially, and attorneys in general, especially estate attorneys, are foremost experts in those areas. And I do a lot of work with estates, so I'd be happy to answer any questions that you have on that. Well, this was a fun topic, and I really enjoyed it. It's kind of one of those things that I always enjoy, just kind of yucking it up about.